quick ratios, which I've said there is purely ideal ratio will always be 1:1. 1:1 will always be actually the ideal ratio in that case there. So we shall be seeing examples on the same. We shall be working out examples on the same that we shall have questions which I'll be doing on the same relating to the assets and the stock that you have there. So that's it for the quick ratios. That's it for the quick ratios. Now I want to go on to the gearing or leverage ratio. The gearing or leverage ratio, that should be number 2. And I've talked about the leverage or gearing ratio mean now measuring the ability of the firm to survive on its own without having to depend on the outsider. So it measures the proportion of the debt finance of capital by a company, and this company is highly geared if the ratio is greater than 50 there. If the ratio is greater than 50, then you see it's highly geared. Meaning now, if whatever they are actually depending on as external loans are actually above 50% of the total funds or the assets that they have, then we say that's actually highly geared. It's a highly geared company there. So the formula here, which talk about it as a debt ratio or the gearing ratio, is always actually the total long-term loans over the capital employed times actually 100 times 100. So the total long-term loans over the capital employed times 100. Now the capital employed, as you know, is actually represented by all the assets actually minus the carrying liabilities. So when you take the capital employed, which is also the net assets, and then you relate it to the long-term loans, the money we borrowed outside, and then you multiply by 100, then that will give you what to talk about the debt ratio or the gearing ratio there, the gearing ratio. So like, for example, if I could give you an example, that our long-term loans are maybe 120,000, and then our capital employed is actually 100,000. Then our debt ratio will be actually, we shall take now the long-term loan, which is actually 120,000 over 100,000 times 100, meaning presented in a percentage form. So whenever you have this, meaning you go to present it in percentage form. So when you take this will give us actually that will be 120%. 120%. So you find that this one actually is a very high gear, meaning you are depending on actually the long-term loans or depending on loans actually from our business. Why? Because it's above actually 50%. So I say whenever it's actually above 50%, then it's high gear. Meaning actually it's high gear. So I found it to be high gear whenever actually the total value of the assets there are actually less than the long-term loans by more than 50%. More than 50% here. More than 50%, then you say it's high here. So that's actually the ratio. So we just want to try to see that at all times the long-term loans should not actually exceed the capital employed. Should not exceed. So we give an example where it does not exceed. Then for example, we have the long-term loans being maybe 150,000, while our capital employed is maybe 400,000. Then you're calculating this to be 150,000 over 400,000 times 100. So this will go here. That's how much? That is 3 means what? That's 12, eh? 3 into 30, because there are 7. It's all.
Yeah.
That's 7%. So that means slowly here, I found there will be some slowly here today. So it's actually done 50%. Otherwise, the other one is what we saw now, our asset being more than that one by that much. And that's actually seen to be high here. So we shall be considering this. This was an extreme situation where actually the loan business is extremely high here. The company is depending on loans. It's only 100, while the other part is actually meaning all the long-term loans are taking more, plus even some, which actually there's no equity there. But in the case where they have some equity, then that's the position that will be there in our case there. So that's what covers the gearing ratio. That's what covers now the gearing ratio there. So, and you find that that's for, first of all, coming out to the capital gearing ratio. And then you have the debt equity ratio. Debt equity ratio. This was actually the capital gearing ratio, nearly the capital gearing ratio. And now that's the total. That's the total capital gearing ratio. And now we look at the equity now, equity ratio. And look at the equity ratio. What belongs to the owner now? That's under the same gearing ratio. That's the debt equity ratio. That's the debt equity ratio. Now in this case, we're still talking about the gearing ratio, only that now here we relate to the equity, purely the net worth, the equity of the fund. This was total capital employed. But here now we're talking of purely that which belongs now to the owners of the business. So here the formula is of the debt equity ratio will also be equivalent to actually the long-term debt. Long-term debts over now the equity or net worth. Over the equity or the net worth. So that's actually our formula relating to that. So here we shall be comparing now the net worth. Net worth, meaning minusing all other debts which actually don't, or we only take the portion of the capital that belongs to the owner of the business, and then let it long-term liability. So if our long-term liability is actually like 150,000, and then we divide it by now the owner's equity, which may be maybe 500,000. Then it shall be actually times 100. Give us the ratio here being is it just this one and this. These two, also this goes with this. 3, 3. So that is 5%. That will be 3%, eh? Yeah, that will be 3%. So that's now the owner's equity. So you shall be doing questions on the same, and then you shall be see how these computations come over time now. So that's what to talk of now as the gearing ratios there. Gearing ratio. Now I want to go on to the next one, which we talked about here as now the activity ratios. ratios there. Activity ratios, so that came first. So under the activity ratios, that should be number what? Number 3. The activity ratios. So activity ratios, I said, we're talking of now the ability of the firm to utilize the asset to generate income or sales. So here we have the data turnover, which relate now to how they're utilizing the debts to be able to generate higher sales there. Then we have the collection period, the average collection period, meaning now we're considering how long we take to collect our debts from the parcels we sold or to on credit. And then we also have the creditors turnover, how we're utilizing now the credits that are being given by suppliers to generate higher sales. And then also the creditors payment period, meaning how long do we take to pay the debts that you have. And then we also have what we call as the stock turnover. Stock turnover, meaning how are we turning stocks into sales over a period that you have. So that will also be considering the period we take to be able to correct or to be able to now convert our assets into sales there. Now, I have the activity ratios here. Activity ratios. One, as I said, is the data turnover. The data turnover. And I said it shows actually the number of times the data is paid within the year. So it indicates how efficient the firm is managing the credit. So the higher the ratio, the more efficient the management is in managing its credit policy. So the higher the ratio, the higher the ability. So a formula here is the data turnover. The formula is the credit sales over the average debtors. Average turnover. Because turnover is the sales there. Over the average turnover. So we shall be taking our credit sales, the total sales that we made on credit. Like for example, we made sales of maybe 2 million. And then our average turnover. Average turnover, not turnover, debtors. Average debtors, sorry for that. The average debtors will give us actually the debtors turnover. So we are considering the credit sales to the average debtors for the period. So maybe at the start of the period, the opening debtors were maybe 240,000, and then at the end of the period, they were maybe 270,000. So we shall actually be taking an average of this divided by 2 to get now the average sales. So it will be 2 million over the sum of that, which gives us actually 400 and or 510. 510 over 2. Over 2 here. So it will be 2 million over, that is 2, and 1, 11 is 5, and 10, 5, 3. So it will be actually 2 million over 255,000. Those are the average debtors, meaning the average period we hold actually debtors before we make them pay to us. So it covers the average debtors there. So I'll be getting 2 million, and it divided by 255,000. That will be 7.8. Which is actually there. 8 times. It's there. So the number of times debtors paid within a year. So meaning in a year they pay 8 times. Meaning in a year they pay 8 times. Well, we've taken actually the credit sales, the amount we sell on the credit, and then consider it to be over the average debtors for the period, meaning we are taking like 2 million over the opening stock of debtors of this, and then the closing stock of debtors are there, or closing balances of the debtors, then divide by 2. So that gives us this divided by 2, gives us 7.8, which is 8 times in a year. So let's start talk of now is the debtors turnover. The debtors turnover. How actually we are converting or making the debtors to pay us on time or not. So this one now, meaning, because we say the higher the ratio, the more efficient the management. Why? Because if they pay more times, meaning we are pushing them to pay us. Or we are having favorable customers who are paying on time frequently. But if it's lesser, meaning they actually don't pay on time. We take time to claim the data. So it's inefficient on the side of the management. Now we also have what we call the debtors pay ratio, that average collection period. I like what we define it as the average collection period. Let's now B. This was A. The average collection period. The average collection period. Meaning now, it shows the average period of credit taken by customers who buy actually items on credit. So it's always comparing the company's allowed credit period by suppliers to give an indication of credit administration efficiency. So this actually shows the average period of credit taken by customers who buy on credit. So meaning now, the collection period, how long do they take to pay us? How long do they normally pay, actually to pay us? So the ratio here, take over the debtors ratio in days. The formula is actually the average debtors over the credit sales. Sales on credit times the number of days in a year. Over the number of days in a year. So if you multiply by 365 days, of course, in a year. So we shall have, like, for example, if the average debtors rate in this case was 255,000, then the credit says you've got it as 2 million. So it will be over 2 million, taking the same example that we have here, then multiply by 365 days. So the average of that will give us the percentage or the number of days actually we allow customers to take on credit. So it will be number of days in a year that our customers actually pay or take and pay for their goods that we sell to them. So you can say 255,000 dividing by 2 million and multiplied by 365. So meaning actually 46 days. 6 days, yeah. So the average collection period is always 46 days. So here we are taking the average debtors, which of course was here, and then the credit sales, which is the same thing. Then now multiply by 365 days. Remember always to multiply by 365 days because it's the number of days in a year. So in 365 days, they take credits and collect the same, or they pay us within 46 days there, which is after one, and we are paying by taking credits so many times in a year. Now the other ratio that you have under the activity ratio is the creditors turnover. The creditors turnover. The creditors turnover. So the creditors turnover, as I say now, this relates to the number of times creditors are paid by us as a company. How many times are creditors paid? So here we're talking of times are paid. How many times creditors are paid by a company in a year? So you find that the number of times we shall be considering now, calculating now, the credit purchases over the average creditors, just the same as this one here. turnover here, taking of now creditors turnover. So we talk of the ratio being creditors turnover being equivalent to the credit purchases over the average creditors. Over the average creditors. Now here we shall also be taking the credit purchase that we made. Like maybe we bought the 1 million as the purchases. And then our creditors at the start, the balances of the creditors at the start maybe was 140,000. And then at the end was maybe 200,000. So this will divide by 2 to get the average. So divide by that one to get an average there. So that of course will be the average or the creditors turnover. The creditors turnover, which will be expressed in actually number of times. So if we have 1 million, first of all I'm dividing, I'm taking the 120, 140 plus plus 200,000. That gives us 340 dividing by 2. The average is 170. So we take 1 million times 70. And 70,000. That's what we finish it down there. So that gives us divided by 170,000. It will be 548, which is 6. That will be now 6 times there. So that's what we have there for the creditors turnover. Creditors turnover. So the number of times creditors are paid. So we pay them 6 times in a year. Then the debtors pay us 8 times in a year, but we pay 6 times in a year. It will not be favorable for us because we are paying more, or we are favorable because we are being paid more than we are paying out. Though, of course, we always want to have us being efficient by paying the creditors on time, but also if you are allowed some allowance, given some allowance by the suppliers to pay less, then it gives us actually an breathing space to cover our other obligations there. Now, the creditors day ratio is just like the debtors ratio. The creditors ratio, that should be now number D. Creditors days ratio. This one actually relates to the number of times the creditors are also, or we are paying actually the creditors. So here we talk of the average deferred period. The average deferred period, the same as this one. The average deferred period, meaning for how long are we being allowed to be able to pay later as the deferred period now. Deferred period. So here the formula for the creditors ratio is actually the average creditors over credit purchases. Over the credit purchases for the period. So we shall be taking the average debtors which we had here as 170,000. 170,000. Then you divide by our credit sales, is 1 million. And as usual, we shall multiply by 365 days in a year. Divide by 360 days, 65 days in a year. So that will give us a ratio there, which can easily calculate. You don't need to calculate that in essence actually. So the last one under this, or not the last one but the second last, so you have as the stock on inventory turnover, still under activity ratios. stock or inventory turnover. When you talk of stock or inventory turnover, when you're talking of now where we consider it indicates the efficiency of the firm in selling its products to generate sales. But now, how efficient is a company in converting stocks into sales? How efficient are we in converting stocks into sales? How actually we are converting stocks into sales here? The ability of the firm to do that. So our formula for here, for stock turnover, is actually the stock turnover is the cost of sales over the average stock. Over the average stock. So that's the formula for calculating the stock or inventory turnover. So that we're measuring our ability to convert stock into sales there. So like for example, if you had our average or cost of sales being maybe 120,000, and then our average stock are maybe are maybe 80,000. Then you should be considering our stock turnover. Our ability to convert cost into sales there. So that will be 120,000. We are dividing it by 80,000. So that will give us 1.5. It's the number of times actually converting stocks into sales, or actually 2. 2.5 or 2. Those are times. How many times are we converting stocks into sales in a year? Simply that's what it means there as the stock turnover. So we need to have a higher figure. If it's a lower figure, then it means we are not doing so much. Meaning we are taking long to sell a stock that we bought. But if it's higher, meaning we buy and sell so many times in a year. So we're able to have higher stock turnover. Now the next one, the last one under this one actually is the inventory conversion period. So this one actually indicates the number of days it takes to convert inventory into sales. So the fewer the number of days, the more efficient the company is converting stock into sales there. And of course, that's purely the stock, the same thing that we just talked about there. Same thing that we talked about there. Now, what I'm yet now to proceed on to is what to talk about now, the profitability ratios. The profitability ratios. The profitability ratios. The profitability ratios. Now, there are, of course, other ratios that I've been talking of there. Now, first of all, I want to brush on the profitability ratios before I can proceed to do more calculations on the same in my next video. Profitability ratios. Now, under profitability ratios, we have several. The profitability ratios. So, under the profitability, I said this is now measuring the ability of the firm to generate higher profit based on the value of the assets and also the stocks or resources that they have. So under this you have the gross profit margin, you have the return on capital employed, you have the net profit margin, you have the net asset turnover, then you have the operating profit or margin ratio, you also have the operating expenses ratio, return on investment, return on equity. All those are actually profitability ratios. So what I'll be doing actually is I want to look at the profitability ratio in my next video. Maybe I'll pick up from there.